Welcome to the Deep Dive, where we take complex research and, well, turn it into knowledge, giving you those critical shortcuts you need.
Hey there.
Today, we are strapping in for a really high-stakes investigation. It's about the future of clean energy, maybe. QuantumScape Corporation, ticker QS.
Yeah, and our source material today is a pretty rigorous investor-focused analysis. It's dated October 16th, 2025, and comes from Stock Analytics AI.
Right.
And look, this is a critical deep dive because QuantumScape, they promise this kind of no-compromise EV solution. We're talking faster charging, better safety, and really game-changing range. The potential is, well, it's industry redefining.
Okay, so the central question, the really high stakes one we pulled from the report is basically this. Is QS the next Tesla? Are they poised to redefine the whole energy storage industry? Or is it the next Theranos, where the ambition just completely outruns the reality?
And the market is definitely placing its bet. The stock closed at $16.24 per share on the day of this analysis. That suggests, enormous optimism. It's pricing in near certain success.
But here's the massive disconnect, and this is what we really need to get into today. Our own risk-adjusted intrinsic valuation model, it spits out a very different range, much, much lower. Like $4 and $9 per share.
Wow, that's a huge gap.
It is. So we need to figure out how the market is possibly justifying that $16 price tag.
Yeah.
And maybe more importantly, what risks is it just choosing to ignore completely?
Okay, to do that, we've got to start right at the beginning, the absolute foundation. Let's kick off with Chapter 1, Business Understanding.
Right. So all the excitement, that entire $8.85 billion market cap, it all rests on one specific proprietary innovation. What is the technical breakthrough? What makes QuantumScape so different from, say, every standard lithium-ion maker out there?
Okay, it's really all about the separation layer. So in a normal battery, you've got this flammable liquid electrolyte separating the anode and cathode.
Right, the liquid part.
Exactly. QS replaces that. They use a proprietary non-flammable solid ceramic separator. Now that ceramic, it does two really key things. One, it dramatically enhances safety, less fire risk. And two, critically, it allows for this revolutionary anode-free lithium metal design.
Wait, anode-free. So they basically save all the cost and weight of building a graphite anode because they essentially grow it. The lithium metal just forms in situ, like right on the separator itself, the very first time you charge the cell.
You got it. It forms right there during the first charge cycle.
That's kind of genius from a design perspective.
It really is. And it's why their flagship cell, the QSE5, has achieved 301 watt-hours per kilogram. That's a range boost that's definitely competitive. And they've also tackled the other big EV pain point, charging speed.
How fast are we talking?
Their batteries can apparently go from 10% to 80% state of charge in less than 15 minutes. Now, that is a seriously compelling value proposition for consumers.
Okay, and their whole business strategy, it seems, designed to minimize risk while trying to capitalize on that tech lead. Right, they're not actually trying to become the next huge factory builder, which, as you said, costs billions.
Exactly right. Their strategy is what they call capital light licensing. They focus on perfecting the really complex technology, the separator, the cell design, and then they license it out to massive partners, like Volkswagen's PowerCo subsidiary.
So future revenue comes from royalties.
Primarily, yes. Two streams. One, high-margin, long-term royalty streams on basically every cell their partners produce using QS tech. And two, upfront or milestone payments. For instance, the report mentions a $10 million payment PowerCo is invoicing in Q3 2025 as they hit certain milestones.
That model makes a lot of sense on paper. But, we can't ignore the market context here. The battery market is huge. Yeah, maybe growing at over 40% a year. But the competition, it's just extreme.
Absolutely. They aren't just up against the established giants like CATL and LG Energy Solution. They're also fighting R&D efforts inside every major automaker, plus other well-funded solid-state challengers like Solid Power, maybe even Toyota's internal work.
Which tells us, really, that the focus has to shift, doesn't it? From, can we invent this cool thing to, can we actually build it reliably and cheaply?
Precisely. And that leads us perfectly into our next section, Chapter 2, Management Evaluation.
Okay, let's unpack this. There was a strategic pivot in leadership, right? February 2024. Co-founder Jagdeep Singh, seen as the visionary, he transitioned, and Dr. Siva Sivaram took over as CEO. What does that shift signal about the company's priorities now?
It signals everything about moving beyond the lab. The company is facing what people often call the valley of death, that incredibly difficult transition from a successful lab prototype to scaled, high-volume commercial production.
And Sivaram's background fits that.
Perfectly. His background isn't just scientific R&D. He spent over 35 years specifically scaling complex manufacturing for things like 3D NAND flash memory, materials science-based tech. He's the kind of guy who understands how to turn a fragile lab project into millions of reliable, low-cost units per year. It's a clear signal. The focus now is operational execution, not just vision.
But they've had some bumps in the road, specifically that 2021 Scorpion Capital short seller report. That was pretty brutal, called the company a scam.
Yeah.
And then there was the securities class action lawsuit that followed.
Yes, and here's where it gets really interesting, especially if you're analyzing the risk profile. A federal judge actually denied QuantumScape's motion to dismiss that lawsuit.
Okay, what does that mean in plain English?
It means that, legally speaking, the court found the short seller's claims, the allegations that the company might have misled investors about its progress, to be plausible risks. Plausible enough to deserve further investigation and discovery in court.
Wow. So even with all the company's public claims about transparency and hitting milestones, the legal system is saying, hold on, these accusations might have some merit. That creates a real tension, doesn't it?
A massive tension. It hangs over their public image and forces investors to look harder. And that legal scrutiny makes us examine where they're putting their money, which of course is entirely focused on long-term survival and getting this tech built.
So no dividends, no buybacks.
Zero. Every single dollar is plowed back into R&D, about $383 million in 2024, and capital expenditures, so building pilot lines and equipment, which they guided to be $45 to $65 million for 2025. It's a pure, high-risk reinvestment strategy, betting the farm on commercialization.
That focus makes sense given the goal, but like you said, the clock is always ticking in these situations. Let's switch gears and look at the cold hard numbers. Chapter 3. Financial analysis.
Okay, the single most important stark financial reality check here is this. For the last 5 full fiscal years, so 2020 right through 2024, QuantumScape's total revenue has been exactly $0. $0.
Zero. That's
Yeah.
sobering. I mean, yes, it's expected for a pre-commercial tech company, but you absolutely have to keep that front and center when you see that $8.85 billion market cap.
Absolutely. And the cash burn. It's not just happening, it's accelerating. Their net loss for 2024 was nearly $500 million, specifically negative $478 million.
Ouch. And the free cash flow. That tells you how fast the money is actually going out the door.
Right. And their negative free cash flow is basically the timer on their runway. In 2024 alone, they burned through $275 million just in their operating activities. They are spending money at an industrial scale, which is necessary for trying to scale up, but it's frankly terrifying when you have zero revenue coming in.
But the massive counter-argument, the reason they're still standing and the market is optimistic, is that balance sheet, right? They raised a ton of capital early on via the SPAC deal and subsequent offerings. They have a big cash cushion.
They do. And the analysis really drills down on how strong that cushion is. It's exceptionally strong. Their debt-to-equity ratio is incredibly low, like 0.03. They're almost debt-free, which is really rare for a company burning this much cash.
Yeah, the current ratio. That measures short-term liquidity.
Exactly. It's extremely high, 16.40. That means they have over $16 in current assets, mostly cash and equivalents, for every $1 in short-term bills they owe. So that fortress balance sheet, that's what gives them years of runway, potentially, even burning cash at this accelerated rate.
Okay, so standard valuation metrics, like price to earnings, are obviously useless here because earnings are negative. So the source analysis used a discounted cash flow model, a DCF, more as an educational exercise, right, to see what kind of future success you'd need to assume to get near the current price.
Precisely. It wasn't about saying this is the value, but what does the market think the future holds? And to justify anything even remotely close to that $16 share price, the model needed some, let's call them wildly aggressive assumptions.
Like what?
Like assuming revenue doesn't even start until 2027 at the absolute earliest. Then you need peak revenue growth rates hitting 70% per year, year after year, for several years. That's phenomenal growth.
And the discount rate, to account for the massive risk that this technology just doesn't work at scale or the manufacturing fails.
This is critical. They had to use a very, very high discount rate of 30%.
30%? Wow.
Yeah. And if you connect that to the bigger picture, a 30% discount rate, that's venture capital territory. That's the kind of rate you use for a very early stage startup where the risk of complete failure, of losing everything, is exceptionally high. It's the financial equivalent of a Hail Mary pass, essentially.
Okay, that starkly contrasts with the current stock price, $16.24, which seems to suggest success is almost a foregone conclusion. Let's really dig into that disconnect. Moving on to Chapter 4, market sentiment.
Right, so you've got the stock trading at $16.24. Yet the consensus among Wall Street analysts, their average price target, it sits somewhere between $5.88 and $9.50. That is a gap you rarely see for a company this size.
So what's going on? Why are the market, the collective wisdom of traders and the professional analysts so incredibly far apart on this one?
Well, the analysis suggests it comes down to what they're pricing. The market, the $16 price, it's pricing the magnitude of success. If QuantumScape pulls this off, if they deliver this battery, it's potentially worth a fortune, right? It revolutionizes EVs. So investors are betting heavily on that low probability but incredibly high payoff outcome.
Okay, betting on the dream scenario.
Exactly. Analysts, on the other hand, they tend to price the probability of success. They look at the immense technical hurdles, the manufacturing challenges we discussed, and they assign a low probability to actually achieving that dream scenario, hence the much lower price targets.
And you've also got high short interest complicating things. About 11.5% to 12.2% of the available shares are sold short.
Yeah, that's quite high. It feels significant bearish sentiment, obviously. Lots of people betting against the company. But it also creates this constant risk of a short squeeze. If QS releases some genuinely positive, verifiable manufacturing news, those shorts might be forced to buy back shares quickly, driving the price up sharply, regardless of the long-term fundamentals. It adds another layer of volatility.
But despite the shorts and the analyst caution, the stock has had strong positive momentum recently.
Undeniably. Looking at the charts around the time of the report, the stock was trading significantly above both its 50-day moving average, around $10.95, and its 200-day moving average, around $7.57. That confirms that sentiment in the preceding months have been quite strong, pushing the price upward.
Okay, interesting dynamic. Let's look at who actually owns the company. Chapter 5, ownership structure. Institutionally, the big one seems to be the Volkswagen Group, right? Through Porsche Automobile Holding SE, they own a massive 15.2% stake.
Yeah, and that strategic alignment is probably one of the biggest de-risking factors for QS. Volkswagen isn't just a potential customer waiting on the sidelines. They are deeply invested. They have a joint venture. They provide testing facilities, engineering resources, and presumably they're lined up to be the guaranteed first major customer if the tech works. That's huge.
That makes sense. It aligns incentives. However, we then hit what the report flags as maybe the single most concerning data point in the entire analysis.
Yeah.
We connect this to the management discussion.
Yeah.
We see heavy, consistent, one-sided insider selling.
This is the really uncomfortable part. We're talking about key executives here.
Yeah.
The chief technology officer, the chief financial officer, the chief legal officer, people who are presumably closest to the technology and the real manufacturing progress.
And they're selling.
They are systematically selling. The report highlights approximately 2.6 million shares sold by insiders in just the last 3 months leading up to the analysis date. And crucially, during that same period, absolutely zero open market purchases by insiders. It's all one way out.
Let that sink in. The people who should know the most about whether this revolutionary tech is about to succeed are consistently reducing their personal financial stake. How do you score that circle?
It's incredibly difficult. It strongly suggests that these insiders, at the very least, view the current market price of $16.24 as fair, or perhaps even generous, for their own shares. It just doesn't align with the narrative of a company on the cusp of imminent, world-changing success.
Doesn't exactly screen confidence from the inside, does it? It creates enormous skepticism that investors really need to grapple with.
Absolutely. It's a major red flag. But okay, to maintain balance, let's move into the formal risk assessment. Chapter 6, Risk Assessment, SWOT Analysis, Strengths, Weaknesses, Opportunities, Threats.
Okay, strengths seem pretty clear by now. Proprietary technology protected by what? Over 200 patents. That deep de-risking partnership with Volkswagen. And the financial endurance from that fortress balance sheet we talked about.
Right. Those are the pillars of the bull case. But the critical weakness, the internal hurdle, what the report calls the great filter, that will ultimately define success or failure. It remains manufacturing and scale-up uncertainty.
The jump from the lab bench to the factory floor.
Precisely. Crossing that chasm, taking something that works beautifully as a single prototype cell, and then figuring out how to make millions or billions of them reliably with high yields and at a low enough cost to compete, that is where almost every revolutionary materials science startup fails. It's just a monumental, incredibly complex challenge.
Okay, and the external threats. Competition, obviously, and maybe the tech just gets leapfrogged.
Exactly. The threats are twofold. Intense competition from incumbents and other startups, as we discussed, and the sheer pace of battery technology development. There's always the risk that even if QS does solve manufacturing, someone else comes along with an even better, cheaper, or easier to manufacture solution before QS reaches mass production, potentially rendering their advantage obsolete.
Now, there's also a fascinating geopolitical angle mentioned regarding potential new U.S. tariffs on Chinese goods. How does that play in?
Yeah, it's presented as a potential dual-edged sword. On the negative side, new tariffs could disrupt QS's own supply chain for precursor materials or specialized equipment, potentially increasing costs even for their pilot production lines.
Okay, makes sense.
But on the positive side, those same tariffs could actually create a massive tailwind for a US-based company like QuantumScape. Think about it. Automakers globally, especially those selling in the US, are desperately trying to build stable, non-Chinese battery supply chains to qualify for things like the Inflation Reduction Act IRA incentives.
Right, the onshoring push.
Exactly. So
Okay.
that geopolitical tension, that desire to de-risk from China, could make a US-developed and potentially US-manufactured battery technology like QuantumScape's extremely desirable as a strategic partner if they can actually execute on the manufacturing. It adds another layer of strategic importance.
Interesting. So it could hurt them on costs, but help them on strategic positioning. Okay, let's try and bring all these threads together now. Chapter 7. Conclusion. Let's synthesize the bull and bear cases and restate that valuation perspective.
Okay, the bull case, the reason for that $16 share price and $8.85 market cap, it really rests on 4 pillars. 1, the potentially transformative solid-state technology itself. 2, the absolutely massive trillions of dollars addressable market for better batteries and EVs and beyond. 3, that world-class strategic partner investor in Volkswagen. And 4, the significant cash runway provided by their fortress balance sheet.
Makes sense. And the bear case, the counter-arguments.
Equally potent, and also resting on 4 main points. 1, that monumental execution risk, the great filter of manufacturing scale-up. 2, the stark reality of zero revenue combined with very high and accelerating cash burn. 3, that deeply disturbing pattern of consistent insider selling. And 4, a valuation that seems completely disconnected from current fundamentals and relies entirely on future perfection.
And reminding everyone of the educational DCF valuation range from the analysis.
Right. The range that needed that aggressive 30% venture capital level discount rate just to be calculable landed between $4 and $9 per share. Comparing that to the market price at the time of $16.24, it just highlights how much future success is already baked into the stock price. The market is pricing in a near certainty on overcoming that massive execution risk.
So the final takeaway for you, the listener to learner, seems pretty clear from this analysis. This isn't really a traditional investment based on current earnings or cash flows. It is purely a binary venture capital style bet.
Exactly. It's a bet on manufacturing execution. If they succeed in crossing that valley of death and scaling up production affordably, the upside could be immense. If they fail to execute, if they can't build it reliably and cost-effectively, the downside could be significant, potentially a near-total loss from current levels. The current price assumes they will succeed.
Okay, that really clarifies the stakes. Now, as we wrap up, we always like to leave you with a final provocative thought to consider.
Yeah, so given that immense cash burn rate we talked about and that really concerning pattern of insider selling, we invite you to think about the timeline here. Even with that strong balance sheet, how much time does QuantumScape realistically have to prove its manufacturing capability before the market finally loses patience? And maybe more practically, what specific verifiable manufacturing metric, maybe yield rates on the pilot line, or defect density, or production cost per cell, what metric should you, the learner, be laser focused on in their upcoming reports to actually gauge real operational progress beyond just the optimistic press releases?
That's a great question to ponder. What's the real proof point we need to see next?
We certainly hope you enjoyed this deep dive into QuantumScape Q dollars. And if you appreciate this kind of targeted, in-depth analysis, you should know this was based on research provided by our friends at Stock Analytics AI.
Absolutely. You should definitely like and subscribe to Stock Analytics AI. For just €4.99 a month, you get access to a huge playlist, 500 deep dive videos covering all the S&P 500 stocks. It's incredible value. And they're not stopping there. Next up, exclusively for members, they are tackling the entire NASDAQ 100 index. Plus, as a member, you can actually request deep dives on specific stocks. Just drop the ticker symbol in the comments on their platform, and they'll work on getting it turned around for you.
Great service.
Yeah.
But finally, we absolutely must remind you, This analysis and our discussion today was generated by an AI system. It's intended for educational purposes only.
That's right. It should definitely not be considered financial advice. Please, always conduct your own thorough research and due diligence before making any investment decisions.
Couldn't agree more. Thanks for tuning in.
We'll see you on the next deep dive.